Welcome back to Investing Talk Podcast.
Today, we're looking at Alphabet.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Alphabet. If you're looking for a story that combines financial resilience, competitive dominance, and a massive technological growth inflection, well, this is it.
Right.
It's not just a cash machine anymore. It's really a foundational tech player that's, actively reshaping its own future with AI.
That framing is crucial, especially when you look at the recent results. The big takeaway for me wasn't just that they had good earnings. It was the acceleration of growth.
Exactly.
We saw a respectable 12% year-over-year revenue growth in Q2 2025, hitting about $89.5 billion. But then Q3 came in, well, it totally shifted the narrative.
It was such a clear sign that their investments are starting to pay off. Q3 results showed revenues accelerating sharply to $102.3 billion.
Wow.
That's a 16% year-over-year jump. And when a company of this scale, operating at over $100 billion a quarter, sees its growth rate jump 4 percentage points like that, the compounding effect is just immense.
And what drove that? Was it just search rebounding, or are we seeing deeper structural changes here?
It was strength across the board, really. Google search remains the anchor, of course, but YouTube advertising showed renewed vigor, and maybe most importantly, Google Cloud continued its march toward profitability and market share capture.
So all three core segments hit the accelerator at once.
That's when you get that 16% print. It signals deep operational health.
And that growth is translating directly to the bottom line, which is equally impressive. Q2 earnings per share were up 17% year-over-year to $1.89. But the real story about stability, the thing that lets them take these massive multi-billion-dollar AI bets, is that balance sheet is arguably the strongest in the entire sector.
It truly is a fortress balance sheet.
Yeah.
As cliche as that sounds. You look at the numbers, they have cash and equivalents totaling $127.3 billion.
And what's the debt against that?
Just $18.1 billion in long-term debt. That leaves them with a net cash position of over $109 billion.
So to put that in perspective for our listener, that $109 billion in net cash it's more than enough capital to fund their entire AI strategy, make a huge acquisition, and run their buyback program.
All without needing to tap the markets or stress their liquidity at all. It's strategic dry powder.
And what does that liquidity look like?
Speaking of liquidity, their current ratio is at 2.1. So they have over $2 in liquid assets for every $1 of short-term liability. It makes them exceptionally defensible against any economic downturn.
That incredible cash generation feeds directly into investor returns. We saw free cash flow in Q2 jump 14% year-over-year to $15.2 billion. That's a staggering amount of cash being generated every 3 months.
And that cash flow supports very tangible shareholder returns. The board recently approved an additional $70 billion share repurchase authorization,
which acts as a consistent floor for the stock price.
A huge floor. And while the dividend is small, the declaration of $1.21 per share quarterly cash dividend in July, it just further signals that commitment to long-term consistency.
Okay, so we've established the financials are robust, they're accelerating, but what prevents this revenue engine from being chipped away by competitors? That takes us right to the competitive moat.
And the moat is exceptionally wide. It's built on network effects and proprietary data that are, they're virtually impossible to replicate.
You start with search.
You have to start with search. Google maintains over 90% global market share. That is a durable competitive advantage that powers everything else they do, from ads to AI training.
And while search is the legacy dominance, the future competitive advantage, that really lies in the cloud, right?
I think so. Google Cloud is the world's third largest provider, holding about 10% market share. And what's impressive here isn't the percentage so much as the growth rate. It's accelerating and pulling more and more enterprise customers into the whole Alphabet ecosystem.
An ecosystem that's now being fundamentally strengthened by AI.
By artificial intelligence, specifically the Gemini platform. And this isn't just some shiny new product. It's an underlying infrastructure layer they are weaving through every single product line: search, cloud, Android. It's a massive defensive move.
It makes their products stickier.
Stickier and more functional and more profitable. We have to talk about the monetization strategy here.
The new AI-powered ad platform for YouTube, that seems like a major catalyst. How is that going to drive incremental revenue?
Well, it uses generative AI to instantly create these highly targeted ad campaigns. It optimizes spending and improves the return on investment for advertisers. It's leveraging decades of user data they have, creating a personalized ad experience that smaller players just can't match.
And if that works,
If this rollout is successful, it adds a whole new high-margin growth layer to an already thriving YouTube segment.
all right, shifting gears a bit, let's look at the technical picture for the listener who's interested in price action. The stock is clearly in a confirmed bullish trend. We've seen higher lows and higher highs pretty consistently since the start of 2025.
That's right. As of late November, the stock is trading near $175. For technical traders, the immediate support level sits firmly at $165. And that key resistance they need to break is $180.
And consolidating above $175 shows that underlying strength.
It does. And the momentum indicators are confirming this trend. It's not just running on hope.
So what are you seeing there?
The price is trading comfortably above both its major moving averages. The 50-day is near $168, and the long-term 200-day is at $158. Being above both validates that sustained trend.
Okay.
And crucially, the relative strength index, the RSI, is sitting at 58.
So for those who are maybe unfamiliar with the RSI, why is 58 an important number? What does that tell us?
It means the stock is experiencing healthy buying momentum without being overbought or overheated. We often look for anything above 70 as a sign that a stock might be due for a pullback.
So 58 is kind of a sweet spot.
At 58, the market has enough bullish conviction to keep accumulating without panicking. The MACD indicator is also positive, which reinforces that there's sustained institutional buying pressure under the surface.
That lower than average sector volatility we've seen also suggests this isn't a speculative frenzy. It's more of a stable accumulation phase.
Absolutely. It's driven by long-term investors who are comfortable with the fundamental story. And that confidence from the institutional side is reflected in the market sentiment we're seeing. Wall Street is increasingly bullish on this AI monetization path.
We've seen some huge moves from the major banks. Morgan Stanley, for instance, raised its price target all the way to $195. What was their reasoning?
They explicitly called out the potential for accelerated AI monetization through Gemini and those new ad platforms. They're suggesting the market is still underestimating the eventual margin expansion this will bring.
And JP Morgan upgraded them as well.
JP Morgan upgraded to overweight, signaling real conviction in the accelerating growth of cloud services.
And this is backed up by institutional ownership, which has climbed significantly to 67%. When you see behemoths like BlackRock and Vanguard increasing their positions, it signals long-term conviction from the biggest pools of capital in the world.
It's a very strong vote of confidence. But we always need to provide a balanced view, especially with insider activity.
Right. So on one hand, it's highly positive that insiders have bought over $12 million in shares in the last 3 months.
Shows faith in the trajectory.
But on the other hand, we have seen some very public sales from senior management, including the CEO, the chief accounting officer this November. How should a learner interpret that seeming contradiction?
Yeah, and that is where the nuance really matters. These sales were conducted under prearranged trading plans, known as 10b5-1 plans.
The automatic trading plan?
Exactly. It's crucial to understand these are set up months in advance for diversification, for tax planning. They are not a spontaneous reaction. It's not management losing faith. It's just planned liquidity.
So it's planned portfolio management alongside a generally bullish outlook.
That's the way to look at it.
That clarity is important. Okay, so looking ahead, what are the near-term hard catalysts in the next 3 months that our listeners should be watching for?
The first major inflection point is the Q4 2025 earnings report, likely dropping in mid-January. The market will look at search and cloud growth, of course, but the key metric will be margin improvement.
Are there heavy AI investments translating into operating leverage, or is the spending just outpacing efficiency?
That's the question. And we have product news coming even sooner this December. New enterprise and consumer-facing features for Gemini are scheduled to roll out right before the end of the quarter.
Which could definitely juice user engagement.
Could drive unexpected revenue increases. Plus, we can't ignore the institutional plumbing. Late December brings major ETF and index rebalancing events. Given Alphabet's massive weighting, this often leads to significant forced buying volume.
Right, which can create volatility and upward pressure. Now, beyond the hard data, let's explore the speculative upside. The things that aren't fully baked into consensus estimates yet.
Well, the most exciting one, I think, is the persistent speculation around the automotive sector. There's growing chatter about a major partnership with a global auto manufacturer to integrate Gemini AI into next-gen vehicles.
That wouldn't just be a licensing deal. That would unlock a brand new market for high-margin recurring software services. That could be a monumental game changer.
Exactly. If that materializes, it fundamentally changes the whole revenue narrative outside of ads and cloud. And additionally, we're hearing these unconfirmed whispers about a potential breakthrough in quantum computing.
Which would obviously provide a huge long-term technological edge. Any other big areas of focus?
Absolutely. Negotiations for large-scale health AI partnerships with major multinational firms are rumored to be advancing. Long-term, don't ignore the possibility of strategic M&A in cybersecurity or specialized AI, especially with that $109 billion in cash.
So we've painted a highly compelling picture, but no company of this scale is without risk. What's the primary headwind?
Regulatory scrutiny remains the elephant in the room. They're still dealing with antitrust focus in both the EU and the US. And while the immediate environment seems a bit less hostile than 6 months ago, the risk of fines or structural changes never fully goes away.
And internally, the competition in cloud and AI is relentless. They aren't running this race unopposed.
Precisely, and that brings us full circle back to the valuation. Management is doing a great job navigating these risks. However, to justify the current premium valuation, they have to demonstrate continued margin improvement and rigorous cost control.
The market needs proof that their massive AI spending is generating efficient returns, not just adding overhead.
That's the bottom line.
So when we put this all together, the financial acceleration, the strategic use of that cash, the dominance in search, and the ambitious push into AI with Gemini, it tells us that Alphabet is executing on its strategy while also laying the groundwork for the next decade of tech leadership.
They possess the capital, the talent, and the market position to capitalize on the next wave of innovation. The key monitoring point for any investor right now has to be those Q4 earnings margins.
The structural drivers are just undeniable. Keep a very close watch on those Gemini feature rollouts scheduled for December and the institutional buying flows that often come with index rebalancing at year-end.
And never forget that $70 billion buyback authorization is a silent, consistent buyer of the stock, offering a baseline of capital support.
Fantastic analysis. That's all we have for today's discussion of Alphabet. If you want more in-depth analysis on market leaders and emerging trends, make sure you subscribe to the show for more analysis.